In a volatile and uncertain macroeconomic and political environment like the one we're living through in mid-2025, there's one word that keeps surfacing in investor circles: safety. But safety doesn't mean going entirely conservative, sitting on cash, or dumping your portfolio into low-yielding bonds. Instead, what savvy investors are doing right now is allocating a portion of their portfolios into reliable, time-tested companies. Stocks with strong financials, stable cash flows, recession resilience, and most importantly, a track record of rewarding shareholders. In today's video, we're going to explore 6 of the safest stocks to buy and hold forever, updated as of June 2025. These picks are not just defensive, they're battle-tested. These are companies that weather storms, generate steady dividends, and have solid long-term fundamentals. Some of them may seem a little boring at first glance, but in investing, boring often wins the race. My name is Nolan Goa, and my students call me Professor G. I started this channel with one goal in mind: to simplify investing. And that's exactly what we're going to do today. So let's jump right into our list with one of the most iconic names in healthcare. Stock hash 1, Johnson & Johnson, J&J. You've probably heard of it, and chances are you use their products on a regular basis. Johnson & Johnson is a global healthcare titan, operating across 3 highly stable sectors: pharmaceuticals, medtech, and consumer health. It's this diversified exposure that makes it one of the safest stocks on the planet. In recent years, J&J has doubled down on strategic growth, acquiring intracellular therapies, expanding their medtech division, and committing $55 billion to U.S. manufacturing over the next 4 years. Their focus on innovation and acquisitions ensures they're not standing still. This is a company constantly upgrading its relevance. Sector: healthcare. Dividend yield: 2025, tilde 3.1%. Years of dividend increases: 62. Payout ratio: 65%. J&J isn't just a safe dividend payer, it's a dividend king. That means it has raised its dividend for at least 50 consecutive years. That consistency is critical for long-term investors. In a period where healthcare continues to be central to the global economy, from aging populations to medical tech, J&J remains a foundational stock. If you're building a long-term dividend portfolio, J&J isn't optional, it's essential. Stock number 2, Procter & Gamble. Now let's talk about a company that's been paying dividends since 1890. That's 135 consecutive years. And not only that, Procter & Gamble has increased its dividend for 69 consecutive years. Procter & Gamble is a consumer staples powerhouse. This means they sell products people use no matter what's happening in the economy. Think toothpaste, detergent, diapers, razors, shampoo. These aren't luxuries, they're necessities. Sector: consumer staples. Dividend yield: 2025, approximately 2.5%. Payout ratio: approximately 60%. P&G is recession resistant. During economic slowdowns, people still buy Pampers, Tide, and Gillette. Its pricing power and brand loyalty are exceptional. Pros: diversified global portfolio, reliable cash flows, strong brand equity, consistent dividend growth. Cons: tariff and supply chain pressures, premium valuation, short-term view, 6 to 12 months. With restructuring initiatives and tariff issues still playing out, you might want to wait for clarity before making large new purchases. Long-term view, 3 to 5 years. This is a must-own for conservative investors. It's a stable cash generator with a rock-solid dividend. Remember, this isn't about home runs, it's about consistency, and P&G delivers that in spades. Stock number 3, Microsoft. When we think of safe, we usually don't think of tech, but Microsoft is the rare exception. This isn't some speculative AI startup. This is a cash-rich, globally diversified innovation machine. And in 2025, Microsoft is stronger than ever. With deep dominance in cloud computing and artificial intelligence, double-digit revenue growth, and fortress-like financials, Microsoft offers a rare combination of safety and upside. Sector: technology. Dividend yield: 0.8%. Years of dividend increases: 21. Payout ratio: 28%. Why is it safe? Because Microsoft's businesses like Azure, Office 365, and LinkedIn are entrenched. Even in downturns, enterprises still rely on their tech stack. Their low payout ratio means plenty of room for future dividend growth. According to Investing.com's AI tool, Warren AI, Microsoft is a fortress with momentum. You're buying the penthouse, not the fixer-upper. Expect consistent stability, not explosive upside. If you want growth without sleepless nights, Microsoft is your anchor in tech. Stock number 4, Visa. Visa is one of those businesses that doesn't need to do much to win. It earns money every time someone swipes a card, makes an online purchase, or buys something on vacation. Visa is basically a toll booth on the global payment highway. Sector fintech/payments, dividend yield 0.7%, dividend growth streak 16 years, payout ratio 20%. Visa's low payout ratio gives it plenty of room for future increases, and its global scale is unmatched. As more of the world transitions from cash to digital payments, Visa keeps benefiting. Pros: high margins, durable growth, strong capital returns, global brand trust. Cons: premium valuation, exposure to economic cycles, potential regulatory hurdles. If you're looking for a stock with consistent performance and room to grow, Visa is a top-tier pick. Just be ready for some short-term swings. Stock number 5, Coca-Cola. We can't talk about safe stocks without mentioning Coca-Cola. One of Warren Buffett's longest-held investments, Coca-Cola is a global beverage juggernaut with more than 500 brands sold in over 200 countries. Sector: consumer staples. Dividend yield approximately 3%. Dividend increase. Streak 63 years. Payout ratio approximately 75%. Every single day, Coca-Cola pays Berkshire Hathaway approximately $2.2 million in dividends. That's $93,000 an hour, $1,500 a minute, roughly $25.87 per second. Why do long-term investors love it? Because the brand is iconic, the demand is stable, and the income is ultra-reliable. It's not a growth rocket, but it's not supposed to be. This is the kind of stock you hold forever. Best for income-focused investors seeking consistency and global brand power. Avoid if you're looking for textile growth or are concerned about ESG or health regulation trends. Stock #6, Berkshire Hathaway, BRKB. Last but definitely not least, Berkshire Hathaway. This stock doesn't pay a dividend, but it may be the safest on the entire list. Why? Because when you own Berkshire, you're owning a carefully curated portfolio of some of the best businesses in America, plus a cash-rich insurance empire. This is a company that reinvests earnings into value-accretive businesses, from railroads and utilities to Apple and Bank of America. It's essentially like owning an actively managed fund, but with ultra-conservative, smart, long-term management. Warren Buffett may be stepping away at the end of this year, but the company has been preparing for this for years. Berkshire's next chapter is built on a strong foundation of discipline, diversification, and deep value. If you want one stock that gives you exposure to a wide swath of the U.S. economy, this is it. Final thoughts. Let's recap the 6 safest stocks to buy and hold in 2025. Johnson & Johnson, J&J. Diversified healthcare giant with 62 years of dividend increases. Procter & Gamble, PG. Recession-proof household name paying dividends since 1890. Microsoft, MSFT. Growth meets stability with fortress-like financials and AI dominance. Visa, V. A fintech toll booth on every global transaction. Coca-Cola, KO. Warren Buffett's favorite brand for a reason. Reliable, global, dividend-rich. Berkshire Hathaway, BRKB. The ultimate anchor stock with diversified strength. These aren't speculative plays. They're portfolio anchors. The kinds of stocks you can buy and hold forever, whether you're a retiree, a dividend investor, or just someone looking to sleep well at night. Remember, building wealth isn't about chasing what's hot. It's about owning what's timeless. Now, if you want to see more videos like this, subscribe to the channel and check out the full breakdown I did on Berkshire Hathaway and Microsoft as part of my personal holdings. Thanks for watching. And as always, keep investing simplified.